Hi everyone, thank you for joining us again. I'm James, Market Strategist at uSMART Securities, and I'll be conducting this 30 minutes webinar starting now. Welcome to Talk Stocks with James series. Surprise! Warren Buffett bought 4 billion stake in TSMC. Should you? And I'd just like to remind you that our webinar is conducted every alternate Thursday, 7:30 p.m. The next one would be February 16. And let me begin with disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. You are responsible for your own investment. Today, I will talk about TSMC, which is my favorite semiconductor stock, and why I think Warren Buffett buying stake in TSMC is an important message to investors. First thing first, let me share a bit of the semiconductor landscape with you. It is a very complicated sector and not many investors understand it, so they choose to ignore this sector. In addition, this is a B2B industry, so normal investors don't really understand. Okay, what is semiconductor? Semiconductors are materials used in electronics to control electricity flow in devices such as transistors. Semiconductor is an essential component of electronic devices. And semiconductors are used in everyday life. You can find semiconductor in all 3C products, namely computer, communication, and consumer electronics. Without a doubt, semiconductor is the cornerstone of all modern technology in the world. The golden law in semiconductor is Moore's law. It basically means that the number of transistors on a microchip doubles about every 2 years. Basically, if you can squeeze more transistors on an IC chip, you have more computing power. So Moore's law expects the speed and capability of our computers to increase every couple of years, and we will pay less for them. To put it simply, every year, the chip in your electronic devices will become better, faster, smaller, and cheaper. Just remember that this is a theory. It is not a law of nature. The semiconductor industry is considered to be one of the most complex industries. Components for a chip could also travel more than 25,000 miles before completion, and there are literally hundreds of companies involved. In terms of semiconductor value chain, front end is basically fabless, also known as design, and manufacturing, also known as foundry. Back end involves packaging and testing. And to support the supply chain, there are equipment and material. This is called the supporting industry, which provide equipment and material to produce a chip. And the end user application involve 5G, AI, VR, cloud computing, data centers, robotic, autonomous driving, IoT, mobile, PC as well. Sorry, just give me a second. Okay, I know all this sound quite complicated, and today we will just focus on TSMC, the company that helps manufacture the IC chips. The main competitors for TSMC are Intel and Samsung. To understand the industry landscape, firstly, you need to know that this is a cyclical industry. The industry cycles are driven by inventories as well as world economic growth. So we could see from the graph here that the world chip sales normally move in line with global economy. So the main risk for this industry would be recession risk. In November 2022, world chip sales went down by 9.2% year over year, and currently everyone expects chip sales to slow further due to recession risk. And no one knows exactly where the bottom is. Next, TSMC revenue normally move in line with world chip sales as well. The world went into recession in 2008 and world chip sales came down. So did the revenue of Foundry company TSMC as well. And since there seems to be a inventory corrections post-COVID, investor expects the world chip sales to come down. So this is why TSMC revenue is expected to come down. The world chip sales growth was 26% in 2021. It's widely expected the growth will slow down to 4.4% in 2022, and this year will drop further to negative 4.1% year-on-year growth. And if you look at global foundry revenue growth, the slowdown in growth is not so obvious in 2022, which you can still see a 28% revenue growth. This is why TSMC revenue was still okay in 2022. But coming to 2023, the growth will slow down to negative 4%. All in all, what I'd like to share here is the whole semiconductor industry's revenue growth slowed down a lot since 2022. But within the semiconductor sector, the subsector global foundry was doing okay relatively in 2022. And this year, the growth would be just negative 4%. But still, market panic and punish all the chip makers. Since the beginning of 2022, TSMC once fell 50% the most and recovered most of the lost ground to negative 21%. Samsung, on the other hand, fell 21%, and Intel fell 43% over the same period. Now, let's talk about TSMC, the best semiconductor company in the world. Warren Buffett bought TSMC listed in US in the second quarter last year. We do not know exactly what Warren Buffett average entry price was, but it was trading at an average price of $82.64 in the third quarter. So it means that if you decided to buy TSMC now at the current price at $94.74, it's not that far apart from Warren Buffett entry price. These are some of the key takeaways. There are some key takeaways from the purchase itself. Firstly, we all know that Warren Buffett invests in businesses with durable economic advantage and a first-class CEO. And in this case, TSMC should fulfill both of the criteria. Secondly, Warren Buffett seldom buys technology stock. This is the first semiconductor stock he ever bought. He bought 4 billion worth of share, which now accounts for 1.39% of his holding, and is the 10th largest position of Berkshire Hathaway's portfolio. This is a serious purchase for Warren Buffett, unlike his other technology holding, Snowflake, which only account for 0.35%. So to me, the Snowflake purchase is probably decided by his business partner, Charlie Munger, but to invest so much in TSMC and becoming your 10th largest holding, it looks like a Warren Buffett decision. Thirdly, the next Berkshire Hathaway 13F filing date may fall in mid-February. So we will know if Warren Buffett buy more TSMC in the fourth quarter last year, this mid-February. And if Warren Buffett really bought some more, we may see share prices pop again because more investors will rush in for TSMC. So what exactly is TSMC, you may ask? TSMC is the world top chip maker that has global manufacturing footprint mainly in Taiwan. It is the world's largest dedicated independent semiconductor foundry, also known as pure play foundry model. Meaning to say, it mainly helps companies to manufacture their semiconductor chips. For example, NVIDIA and Apple will design the chips, and ask TSMC to manufacture for them. And based on clients' requests, TSMC also does a little bit of packaging as well, but its main focus is still on manufacturing chip. It is now the 10th largest company in the world with market cap of 480 billion. It is once worth 580 billion, which is the highest in 2021. Given it is the best semiconductor foundry company in the right industry, I think it is likely to go past 1 trillion one day. And given the share price has fallen 37% last year, it probably has priced in most of the semiconductors down cycle, that I think that this year will be one of the better timing to accumulate for long-term investment. Currently, 12 analysts recommend buy, 3 recommend hold, and the upside potential is 5% with a target price of $100. Their main customers include Apple, AMD, Qualcomm, and NVIDIA. To me, TSMC is a proxy of semiconductor industry. If Apple and NVIDIA do not do well in business, TSMC revenue will slow down. If TSMC suffers a setback in revenue and decides to cut its capex, then the EUV lithography machine supplier ASML will also suffer a drop in revenue. Apple is one of the most important customers to TSMC. Basically, before 2020, Apple used Intel CPU in his Mac computer and later on part ways with Intel and designed its own M1 chip and asked TSMC to produce the M1 chip. And it paid off, which has sent Apple Mac business flying. So the moral of the story here is, firstly, TSMC makes better chips than Intel. Secondly, some companies don't want Samsung or Intel to manufacture their chips because they are afraid that Samsung or Intel will steal their chips design and in the end compete with them. But they won't have the same problem with TSMC because TSMC is a pure play foundry. And you will always hear some stories about some companies like NVIDIA wanting Intel to produce their chips instead of TSMC. And that is understandable because these companies are afraid of geopolitical risks. I am not a geopolitical expert to comment on the situation involving TSMC and China, but to me, it is completely natural that NVIDIA partners with Intel in addition to its existing partner TSMC to produce NVIDIA chip. NVIDIA's want to do that in order to diversify its risk. And this is the reason TSMC starts building more plants in US and Asia, especially in US itself. TSMC will introduce 4 nanometer and 3 nanometer technology to US plants in Arizona. And TSMC will start the 4 nanometer production by 2024 and 3 nanometer production by 2026. This basically tells you that TSMC is also afraid that geopolitical conflict will have widespread effects on future chip production for TSMC's international customers itself. But one of the greatest investors, Warren Buffett, does not care about the geopolitical risks and decided to invest in TSMC. So why shouldn't you? Or I should say, this is probably one of the overhanging risks in investing in TSMC that you need to bear being a TSMC investor. An investor like TSMC, because TSMC holds the largest share of global foundry market. Taiwan currently controls 66% of global foundry capacity in 2022, up from 64% in 2021. Runner-up is Korea with 17%. Out of this 66% market share, TSMC owns the majority. It owns 60%, and the remaining 6% is owned by UMC. And you can see over the past 2 years, TSMC has increased its market share from 56% in 2021 to 60% in 2022. And because of industry dominance, normally the profit margin is excellent. TSMC offers investors one of the best profit margin in the technology industry. In the latest quarter, you can see that gross margin increased from 52% in the first quarter 2020 to 62% in the fourth quarter 2022. Operating margin improved from 41% in 2020 to 52% in the latest quarter. You might ask how TSMC can generate so high operating margin, especially the gross margin and the operating margin is just 10% apart. It is because the operating expenses is low. Net margin also improved from 38% in 2020 to 47% in the latest quarter. And these are the kind of profit margin you don't normally see in an asset-heavy company, or you seldom see such a high margin in large cap technology company as well. For example, in terms of operating margin, let me repeat, TSMC recorded 52% in the latest quarter. Microsoft is just 38%, Apple is 37%, Tesla is 16%. So if your investment thesis is to look for a high profit margin company, TSMC is one of the best choices here. So how TSMC achieves such a high profit margin? Firstly, economy of scale. Secondly, it is producing more advanced nodes that have better profit margin. To put it simply, advanced nodes means smaller chips. They are 7 nanometer and below. In 2019, the revenue contribution for advanced nodes is just 27%, and in 2022, 53%. And if you look at the detailed breakdown, you could see that the 5 nanometer chips accounts for 32% of the revenue in the latest quarter from 0% in 2020. And TSMC has control over 85% of the market for chips between 5 nanometer and 10 nanometer. And the remaining 15% is controlled by Samsung. And here is to show you TSMC technology process roadmap. It is important because it tells you when TSMC could further improve its profit margin. Basically, when they launch smaller chips, they will earn better profit margin. Firstly, let me repeat, the smaller the process nodes, the larger the number of transistors used inside a chip. The higher the transistor count, the more powerful and energy efficient a chip is. And TSMC expect to release 5 entry nodes, which are 3 nanometer chips over the next 2 to 3 years' time. Currently, 3 nanometer technology has successfully entered volume production with good yields. The production yields on 3 nanometer is near to 80%. And the first generation vanilla entry nodes is expected to be used by Apple, but we need to wait until second generation entry E for mass production for mass production to see a bump in revenue for TSMC, because N3E is expected to be adopted more widely than the vanilla N3. Unfortunately, N3E mass production is scheduled to start in third quarter this year itself. Why many companies would like to wait for N3E instead of N3? Because N3E is a better version, will have even faster time to yield, increased yields, higher performance, and lower power as well. And most importantly, lower cost. And TSMC say that the N2 technology is expected to go into productions in 2025 using nanosheets process. But at this moment, you probably see media reporting that Samsung won the 3nm chip race, because Samsung is the first foundry to use the new technology GAA FET to process the 3nm chips itself. Very quickly, GAA FET is the same as nanometer FET being called in TSMC, and is the same as ribbon FET being called in Intel itself. They are the same technology but using different naming conventions. So Samsung adopts GAA FET first for its 3nm, so it gets all the media outlets excited. But TSMC is currently using the old technology, FinFET, to make its 3nm chip. Basically, looking at the roadmap itself, you will realize that TSMC will only start using nano chip FET, also known as GAA FET, in its 2nm productions. So is TSMC falling behind? Not exactly so. The main reason for TSMC to use FinFET for its 3nm chipset is the yield rates. It's currently standing at 80%, but the yield rate of using GAA FET for Samsung is just as high as 20% now. So TSMC basically thinks that the new technology GAA FET is not ready yet. The yield rate is low, so it will wait until 2nm to start using GAA FET. So to me, the most important battle is in 2025, when every company, namely TSMC, Samsung, and Intel, begin 2nm chips using the new technology GAA FET. In any case, it does not mean that TSMC does not possess the capability to produce chips with GAA FET, because if you look at the GAA-related patent applications filed by TSMC, you could see that TSMC filed the largest patent share. So there is a misconception to think that just because Samsung got there first, it is the best now. Next, I also want to look at the revenue breakdown by platform. Here shows you that the smartphone and high performance computing account for 80% of the total revenue. Over the years, smartphone segment is losing its significance, and currently HPC, which include PCs, tablets, game console, and cloud computing servers, is the segment that contribute more to the overall revenue, from 33% to 37% in 2022. It is still a growing sector, as HPC growth in the latest quarter is 10%. And the smartphone segment decreased by 4%. Internet of Things decreased by 11% quarter on quarter. Automotive segment increased 10% quarter on quarter, but it just accounts for 6% of the total revenue itself. I know a lot of TSMC investors have high hope on automotive segment due to autonomous driving and EV outlook, but it's not going to provide much support to TSMC revenue in near term. And in terms of smartphone revenue, fortunately, Apple is the main revenue contributor for TSMC. And even though the overall smartphone industry is bad in 2022 by falling 11% in shipment, Apple's shipment just fell by 4% year over year. But still, according to Morgan Stanley, the global smartphone shipment is still quite weak in 2023 itself. However, I'm not so worried about Apple. To me, if Apple's customers don't buy Apple phone this year, they will buy it next year. As for HPC segment, it is a record year-on-year PC shipment decline in Q4 2022. But again, MacBook by Apple only dropped by 3% year over year. And Apple grew 2.5% in the full year of 2022. In summary, TSMC is not as bad as other foundry because of Apple. But since cloud computing CapEx is expected to slow down further in 2023, we should not expect much growth in HPC segment this year. For example, Microsoft just released the latest earnings result. Microsoft Azure just grew by 31% in the latest quarter, and which is a decline of 15 percentage points year over year. It basically tells you that other cloud players will not do well as well. And hence, overall, cloud segment demand is not good this year itself. And I also want to address one of the biggest concerns for TSMC in the next 2 slides. Investor has been asking how bad is inventory corrections at clients end, because TSMC customers overorder as they build inventories as a buffer against the massive uncertainty in supply chains following the outbreak of COVID-19. Now customers are taking action to clear the hefty chip inventories. But from the revenue itself, we could see that revenue and earnings are still increasing, both from a year-on-year perspective or quarter-on-quarter perspective. So maybe the better question is why revenue doesn't reflect the inventory corrections problem that you see in many companies like NVIDIA. The reason for that is TSMC charges higher selling price. So despite shipment decreases, revenue is still up. And the best way to check if TSMC is facing inventory correction is to look at the shipment. So from the wafer shipment, year-on-year decreased by 0.6%, quarter-on-quarter decreased by 6.8%. And this might be just the beginning. The worst is yet to come. Days sales in inventory, which indicates how soon you can convert your inventory into sales, also show that it's near the highest at 84 days. So market participants are also scared that clients will continue to cut order because of inventory corrections, and hence the profit margin for TSMC will be lower. But it's not a major problem for me because TSMC has good pricing power. TSMC always raise their selling price. And I think what TSMC has been practicing is TSMC allows clients to amend their order to a lesser quantity. So if clients are worried their customers' demand are not strong, they can ask TSMC to amend the contract. But the problem is, if clients really amend and later realize the demand is stronger than expected and decide to place a new order, the new order will be charged at a higher price, at a higher cheap price. So this is how TSMC solves the inventory correction problem. You want to change your order, I allow you to do so, but I will charge you a higher selling price. Because every quarter I will be raising my selling price. After all, one thing I like about TSMC is TSMC always beats or meets its own earnings guidance. So on earnings announcement day, typically there is not much downside surprise on earnings day itself. In the following quarter, TSMC expects revenue could fall from 19.9 billion last quarter to 16.7 billion, a maximum 17% quarter-on-quarter drop in revenue. Gross margin could drop from 62% to 53.5% to 55.5%. And operating margin could drop to 41.5% as well. So the forward guidance by TSMC is quite bad. But the share price has recently rebounded a lot, as TSMC is also saying that they are predicting a recovery in the second half this year, which means investors probably can see slight growth for the whole of 2023. So investors nowadays are speculating the inventory problem will be over sometime this year. Overall, global economic slowdown, higher interest rate for longer, less remote working, everyone opting for outdoor activities post-COVID, semiconductor bust cycle are all sort of reasons that stop investors from investing in TSMC. Again, if you really don't like this sector or TSMC, you can short sell the semiconductor ETF or short sell TSMC using our uSMART Securities app. But if you like this company, there are key support and resistance levels you can look out for. Let's quickly talk about the technical analysis. First thing first, I want to establish that the target price for double top is $72.95, and TSMC overshoot the double top target price by hitting 138.2% extension level at $60. And hence the low here might be the bottom, might be the ultimate bottom for TSMC. Secondly, if we were to draw a Fibonacci expansion based on November low to December high last year, and then mimic the expansion over here, we could see that the extension of 138.2% is $106, which is also the double top net line as well. Probably 61.8% would be a good entry price if there's any corrections itself to $87.7. Thirdly, you could also draw an imperfect inverted head and shoulders with a target price of $106.2. Again, we see 106 as the key resistance level. There should be a lot of profit taking or some profit taking at 106. This should be proven to be one of the key resistance level. And the current price is 94.74. And I think a lot of investors are trying to time the entry price for TSMC because everyone is predicting that semiconductor is going through a down cycle. I totally agree. But I don't think necessarily that you should avoid, because if this is an economic soft landing, the damage will be small. If inventory problem is proven to be less severe than expected, because the demand from AI, automotive segment is still strong, then the damage will be smaller than expected. And as I share, TSMC will always be hurt the least because of its industry dominance, especially its N3E will be ready for mass production later this year. So, but if you are so worried, if you like TSMC but don't want to gain too much exposure into it and still want to enjoy the benefit of TSMC exposure, you could gain exposure from the ETF that holds stake in TSMC. For example, I share MSCI Emerging Market ETF, ticker code EEM, with 26 billion AUM invests 5.6% of its holding in TSMC. If you want to gain the entire semiconductor value chain exposure, you could either invest in SMH ETF or SOSS ETF. But personally, I prefer SMH ETF because it has 11% exposure in TSMC compared to SOSS here, 3.9% itself. Lastly, let me end the TSMC presentation with this performance and risk ratio slide. Here show you the year-on-year return of TSMC, Semiconductor Index, NASDAQ, and S&P 500. And here show you the maximum drawdown and the volatility of these indices. There are a few key takeaways here. Firstly, since TSMC listed on NYSE in 1997, of all 25 years, TSMC outperformed Semiconductor Index, outperformed NASDAQ, outperformed S&P 500 over 11 calendar years, which means if you invest in TSMC, 44% of the times you end the year with the best performance. Secondly, TSMC is very volatile. Over the past 10 years, the maximum drawdown for TSMC is negative 59%, whereas the drawdown for Semiconductor Index is just negative 47%. NASDAQ is negative 37%, and S&P 500 is negative 35% itself. And from the annualized standard deviation, we could also see that TSMC has the highest volatility at 30. Thirdly, market is fair. With higher volatility, it also brings higher return as well. For example, TSMC returned 27% year to date, outperforming Semiconductor Index 22%, outperforming NASDAQ 13%, and S&P 500 7%. And we could also see that from the 15-year or 20-year annualized return, TSMC also outperformed other indices here as well. In summary, I think TSMC is not for every investor because it's too volatile. I believe that every growth investor knows that TSMC is a good company, but not many can withstand the volatility. It's just not for everyone. Again, my solution to this is, if you cannot take the volatility, you may consider the ETF. Like SMH ETF, it is also a good semiconductor ETF that provides you the exposure to the entire semiconductor industry. Otherwise, instead of investing 20% or 30% of your portfolio is in TSMC, you may invest maybe just 3%. That way, you still can gain exposure, but not over-risking your portfolio. But if you are an aggressive investor, I would say that probably not more than 15% of TSMC in your portfolio. Okay, and currently, uSMART Securities would like to reward new customers who listen to this webinar with $2. So if you are still a new customer and have not yet deposited money in your trading account, please type in your uSMART account in the Q&A box in the Zoom webinar. We will transfer the cash voucher into your trading account. And we are also running an interest reward promotion as well. If you have some idle cash, you may like to participate in this interest reward promotion to enjoy up to 4.6% per annum in interest. The promotion is available for USD and Sing dollar. The minimum deposit amount is 500 USD or 2,000 Sing dollar respectively. The login period is 6 months for USD and 1 month for Sing dollar. Basically, you need to submit your interest in our app to partake. And it's very easy to join. Just go to your uSMART app, click on the banner on top of your app, and you can find all the information here, including the step-by-step guide. Yup. And that's all for this webinar. If you have any question at all, please type in the Q&A box and I will answer one by one. Okay, I see the first question. What about ASML? Is it a good company? Yes, I like ASML. ASML is always one of the big cap semiconductor names that I like, along with NVIDIA, TSMC as well, and probably AMD. ASML, as you know, makes the best EUV lithography system in the world. Only it can make it, not other company. Every company in the world is lining up to order from ASML. So this is why ASML has strong pricing power. On a normal day, I would say that ASML can charge whatever it wants, and every company will still pay for it as long as it can, as long as ASML can deliver the order itself. And we can also see that during the COVID shutdown, it has a supply problem because of bottlenecks in shipping. Currently, it has a demand problem because a lot of semiconductor company like TSMC is cutting capex due to slowing demand itself. Another major risk for ASML is the PE ratio is always too high. I believe it's standing above 40 times right now. The last I checked is 44 times PE ratio. And since 2020 or 2019, most of the times it's trading above 40 times PE ratio. To me, I am only interested if the PE ratio can come down to lower than 40 times. In short, excellent company, good pricing power, but expensive valuations. Maybe that is a better entry price for all of us. Okay. Okay, another question related to ASML as well. Is potential EUV ban a risk to ASML? Okay, I think you probably have a typo because ASML has not been selling any EUV machine to China since 2019 or 2020. But ASML can continue to sell DUV lithography system machine to China. And China is a big DUV market for ASML. And I believe you are asking because over the years, US government has been lobbying Netherlands government to stop ASML from selling to China. So the answer is yes. If ASML cannot sell to China, it will be a big problem for to ASML, because China can buy from other places like South Korea and Taiwan, but they won't be as good as ASML DUV itself. Okay. Okay. What do you think of Intel, since it offers lower PE ratio? Okay. I think Intel just released the earnings statement, and the Intel PE ratio should be higher now, higher than TSMC itself. But in the past, I would say that I agree with you. Most of the times, Intel is cheaper in terms of PE ratio. And I think this is always the main reason why people are investing in Intel instead of TSMC. I think Intel is a value trap. I reckon that the current CEO, Patrick, always talks the talk, but not exactly walks the walk. You can see him talk about IDM 2.0 in every interviews, try to regain investor confidence, but still the earnings are quite bad. I mean, Pat Singer really wants to change things. This is why you have been seeing him going to Taiwan a lot. I believe that he probably visited a lot of Taiwanese partners because he knew that in order to improve Intel yield, production yield, you really need to get the ecosystem right, which is to get the material right, you need to get the equipment right as well. And that's why he visited Taiwan, to persuade those Taiwanese companies to sell them, to sell the equipment to Intel as well. But so I would say that he might be the right CEO for Intel, but and US, we can see that United States is also supporting Intel a lot. US lately signed a chip bill to subsidize Intel. Regardless, I reckon that Intel's share price has been underperforming relative to TSMC for many years now. That really tell you that investors nowadays prefer TSMC to Intel. So I guess if you are asking which one I prefer, my answer to that, my choice is always TSMC. Okay, S&P 500 has gone up a lot. Is it a good time to buy? Okay, another good question as well. Thank you for asking. Yeah, and okay, it's a tough question as well. Thank you for asking. So indeed, I spent a lot of time asking myself this question over the weekend. As we can see, S&P 500 probably rebounded 7% year to date. So if you put your money into FD, fixed deposit, which is earning you 4% interest, you might be thinking that stock market actually has provided a better return year to date. And I think I got a slides for this. Just 1 second. Okay, pardon my drawing. My base case is stock market will go up in short term, and then suffer a massive drop in the first half of this year, and then probably rebounded a lot in the second half of the year and end the year higher. So the question here is why I think it will suffer a drop in first half, because mainly I think the earnings expectations has not come down enough. I think there is still a lot of correction in the earnings itself that will pull the S&P 500 lower. But lately, you can see that S&P 500 and every other indices has been popping. So I am thinking that what if I'm wrong? And the stock market actually rebounded a lot this year, which come to the second scenario, which it may continue to go up and itself, and then we may see the year high in the first half of this year, and then it will suffer a drop in second half of this year, and then probably end the year higher or still below the high that we see in the first half of this year itself. I would say, is that possible? I've been asking myself. I would say the answer is yes. It's also likely. But what could be the reason for S&P 500 to drop in second half? So my answer to that is probably the inflation is higher in the second half. There would be a reversal in inflation. Even it's dropping now, but it could be some spike in inflation, maybe due to oil prices or some other factors. And earnings might be still coming down, or there are some technical corrections, or even we might see the USD is appreciating in the second half. But if you were to ask me now, I would say that the first scenario looks more likely to me. This is why I would say that you should have positions, some of your holdings into defensive asset allocations, but not risk all your money into risky asset now. So to answer your question, is this a good time to buy? I would say that we do not know whether this is a dead cat bounce, because one of these dead cat bounces, right, will ultimately become the real deal and eventually pull the market higher. So no matter what, you need to have some positions. So the answer for that is you need to ask yourself, do you have enough exposure in the market already? If not yet, you should have some enough exposure in the market, because this might not be the dead cat bounce and eventually go higher, because this might be the second scenario. But if you were to ask me, I think market could still go down in the first half of the year itself. Yeah. Yeah. I think we have overrun. Yeah. Let's call it a day. Yeah. Again, thank you everyone for coming to this webinar. Thank you, and I shall see you 2 weeks later. Thank you. Thank you so much.